So guys, there's a lot of opportunities in the Nigerian stock market, especially now that the all-share index is moving higher and hitting all-time highs, heading towards 150,000 naira. So there's a lot of money you can make in the Nigerian stock market. But if you don't have the right strategies, you will not be able to benefit from the thousands and millions of naira other traders and investors are making. And that is why in this video, I'll be showing you the 5 profit trading strategies that will earn you big profits in the Nigerian stock market that Nigerians like you can start using today. Whether you are investing for long-term growth or trading for short-term profits, these strategies can help you trade with confidence. This is not Wall Street jargon. What I'm going to show you are just practical steps that work here in Nigeria. So make sure you just watch till the end of the video to get all the tips that you need when using these strategies, so you can have a better edge at winning your trades and making more money from the Nigerian stock market. If this is your first time here, you're most welcome to my channel Trade with Rigs, where traders get ahead and learn how to build wealth and gain financial freedom by making smarter moves in the stock market. You can hit the subscribe button and turn on the notification to get notified anytime I upload a new video, so you don't miss out on any new updates or videos that I post. And you can also give a thumbs up to like and share and help this video get at least 1,000 likes. So without further ado, let's dive in. The first strategy is trading with the market trend, and is popularly known as the trend following strategy. This is one of the most popular ways traders use to generate trading signals. It involves identifying and trading in the direction of the market trend. The idea behind this strategy is to realize larger winning trades and bigger profits by studying what direction the asset price is moving to determine whether to buy or sell the asset. So if the trend is heading upwards, it means that the price is making a progression of increasing higher highs, and so you can take a long position and buy the asset. And if it is moving downwards, it means the price is making a progression of increasing lower lows, and so the trader should take a short position by selling the asset. So first, you must identify the existing trend in the market, and then you search for trading opportunities that earns you profit when the trend continues. The trend trading strategy can be used for short-term trading and long-term investing as well, because you can hold your position for as long as the trend continues, and that way you make even more bigger gains. The only difference is that for day traders who are using the trend trading strategy on the intraday time frame, they would usually close their long positions before the close of market session. There are different ways to find trend following trading opportunities, and tools like moving averages, chart patterns, trend lines, and other technical indicators can help you identify these trends in the market. In the NGX, the trend is your best friend, especially with stocks like GTCO, MTN, and Dangote cements that move in strong cycles. Now let's go to the chart and see how this works. For this, I'll be using TradingView, which for me is one of the best charting platforms out there, even for Nigerian stocks. So when trading with the trend, you use a 50-day or 200-day simple moving average or exponential moving average to guide you. There's really no much difference between the simple moving average and exponential moving average. So anyone you use, you will still be able to identify the trend. If the stock is trading above the 50 or 200 EMA line and the market index is bullish, then you look for buying opportunities. And if it's trading below the line, you tread with caution. You either avoid taking any trades or you just focus on selling your open trades. One important aspect to note is that when using trend following strategy, you will not be able to capture the whole move, since you have to wait for the trend to establish first. And so because of that, you will most likely miss the first part of the trend, just like in this case of GTCO. So if you were not already holding GTCO shares when it was trading around this 40 naira or around this 46 naira or 52 naira here, you would have missed at least from 6 naira to 12 naira of this move to 103 naira or wherever you decide to sell it. And don't make the mistake of trying to predict when a new trend will emerge before the actual signs are present. Because when you try to do that, you will be tempted to take trades too early and then realize unnecessary losses. So you must always be patient to wait for the trend to emerge. The second proven strategy that works in the Nigerian stock market that you can use is the breakout trading strategy. The breakout trading strategy involves identifying key levels of support and resistance so that when price breaks through and moves outside these defined levels with increased volume, it is a signal that price will continue moving in that direction and lead to large price movements. So when you enter a long position after the price breaks above a key resistance level, you can capitalize on the momentum. This approach allows you to take a position within the early stages of the trend and can be very effective in volatile markets. But the thing is, when using this strategy, you have to carefully monitor the price charts to make sure you enter and exit early enough to maximize your gains. The good thing about breakout strategy is that you can easily profit from short-term market actions. And whether you're holding a position for long-term or you are day trading or swing trading, the concept works equally well, regardless of what time frame you're trading on. Breakouts are common in most markets, and Nigerian stocks often move sharply when breaking key price levels, especially when there is a news catalyst, like after a corporate announcement or earnings report release. But there are also some limitations with the breakout strategy you should be aware of. One is that a false breakout can occur. This is when price moves above a resistance level or below a support level but fails to continue in that direction. And this can lead to you entering too early. That is why you must always confirm breakouts with increasing volume and always place your profit target and stop loss orders to manage your risk. So always watch out for a breakout above a recent resistance with high trading volume. That's usually a confirmation signal of a strong momentum. The third one is buying the dips. Now, one common phrase you often hear, especially from successful traders and investors, is buy low and sell high. And this is the one strategy rooted in that principle. Buying the dip strategy involves finding individual stocks whose prices have recently dropped to look for buying opportunities. Now, this does not mean that you should buy any stock simply because you notice it has fallen greatly in price. No, rather you look for stocks with promising fundamentals and then buy at their depressed price point, which is the dip, having the expectation that the stock will bounce back enough for you to make substantial profits. When you buy the dip, it literally means that you're opening a position at this point and aiming to sell when the market price has rebounded. This is the formula for successfully buying the dip, and you can utilize tools like stock screeners to identify securities that meet your criteria of a dip. The idea behind buying the dip is that you enter trades to buy when price pulls back to a support level in an overall uptrend. Now, how much the price has to pull back before you enter a trade depends on your trading style. For day traders or scalpers, it means you watch closely for any small fluctuation in price of, let's say, 5 to 10% drop, which is likely to be a temporary or minor shift in trending markets and will usually last maybe for a few minutes or hours or even seconds before you sell, and hopefully it will be at a higher price. And for those who plan to hold for a much longer term or swing trade for a couple of days or weeks, they will have to wait for a bigger drop like 20% or more, and this may take days, weeks, or even months. All markets have fluctuations and pullbacks, and not every dip is bad news. In the Nigerian stock market, there are strong blue chip stocks like MTN, Dangote Cement, Guinness, Nigerian Breweries, Seplat Energy, or Airtel, and these stocks often bounce back after temporary pullbacks. The good thing with this strategy is that you can use it to trade not only stocks, but also ETFs, Forex, crypto, or any other assets, and it works with any time frame, whether it's the weekly, daily, hourly, or 15 minutes to 1 minute time frame. However, and this is a very crucial point to note, you must determine whether the dip is just a temporary downturn or if it's actually a market reversal, because a temporary fluctuation lasts for only a short time, while a market reversal means a fundamental shift from an uptrend market to a downtrend market, and this will most likely take a longer time for the price to bounce back. So have this in mind, okay? The next proven strategy is trading within a range. You should know that the Nigerian stock market doesn't always move up or down. Sometimes it just moves sideways, and that's where the range trading strategy shines. So, trading within a range strategy is a simple and effective strategy that involves identifying the highs and lows of a range and then execute trades of those key areas of support and resistance. This means that you buy when the price hits the support level, which is the lower boundary of a range, and sell when the price hits the resistance level, which is the higher boundary of a range, taking advantage of price bouncing between two levels like a ball in court. This strategy allows you to focus on price levels and allows you to set precise profit targets and stop losses, and also to make decisions without unnecessary complexities. On the NGX, you can spot ranges by looking for stocks moving between two price points for weeks or even months, with no clear uptrend or downtrend, just sideways movements. Just like in the case of Zenith Bank here, you can see it was trading within this range of 29 Naira to 45 Naira from June to December 2024, before breaking out above this resistance level of 45 Naira. And you can see how many times it pulled back and moved back up within the same range. And these are clearly trading opportunities for you. You enter near the bottom, which is support, and you exit near the top, which is resistance. But remember to always confirm with trading volume at both levels of support and resistance before pulling the trigger. The range trading strategy is a great and easy strategy for those who are just starting their trading journey because it helps you to remove any emotional trading decisions. But also note that it requires a lot of patience because it can take a long time to get to these levels, and price may go in your favor or against your positions on a daily basis. So be prepared for long holding periods. Also bear in mind that price may not reach your target support or resistance and may only stop close to it or at certain periods. And in this case, you may want to adjust your target entry or exit levels. You also have to watch out for false breakouts, which happens when price briefly moves beyond the range only to snap back like in the case here. This often traps inexperienced traders. And the fifth strategy for the Nigerian stock market is trading earnings and dividend seasons. So earnings are quarterly reports released publicly by companies that contain details of their financial performance, that is their revenue, expenses, and net income over a 3 month period. And this report is important for investors and traders likewise because it gives an insight into the company's operations and tells how the company is performing financially. And this helps you to determine whether you should buy the stock or not. So this makes the earnings season attractive because it generates a lot of volatility in the market. So occasionally, these stocks experience sharp price movements immediately before or after their earnings announcement, and this provides the opportunity to take compelling trades. And dividend, on the other hand, is a periodic cash payment received by stockholders, representing their own share of company's profit. And these periods when dividends are paid are referred to as dividend season. But if you're only interested in receiving the stock's dividend and not holding it, then it is important for you to watch out for the key dates that occur in the dividend payment process, like the declaration date, the ex-dividend date, the record date, and the pay date, so that you know when to buy and sell the stock and not miss out on receiving the dividend. The idea of this strategy is to buy the stock like 2 or 3 days before the ex-dividend date, and then sell it either on the ex-dividend date or at a later date. Because only stockholders who own the stock on the ex-date will be paid dividend, regardless of whether you still own the stock after the date. So, investors and traders in the Nigerian Stock Exchange eagerly anticipate the earnings season because it comes with a lot of market activity and opportunities. A company's earnings report or dividend declaration can trigger sharp movements in the company's stock's price, depending on whether the result meets, exceeds, or falls short of expectations. And during these seasons, the stock market often reacts quickly, with prices jumping up or dropping based on the latest earning news or dividend announcements. If you take positions early enough, you can catch quick gains. So always check the release calendar on NGX website so you are informed beforehand and not caught off guard, and you can plan your trades around payouts. Okay? And that's it. These are the 5 proven strategies for trading Nigerian stocks. Following the trend, trade breakouts, buying the dips of quality stocks, trading within a range, and tracking earnings news and dividend dates. While it is true that long-term investing produces higher gains and higher returns, however, there are equally incredible opportunities for short-term traders in the Nigerian stock market. When trading, remember to start small with a small position size. Keep a trade journal, stay disciplined, and always remember that the stock market rewards traders who plan their moves. Never go into the market without a plan. Always plan your trades and trade your plan. That's the rule of the game, okay? So if you found this video helpful, don't forget to like and subscribe, and drop a comment telling me which strategy you start using today. Thank you all, and I'll see you in the next video.